Welcome to today's video on mastering your small business finances. In this session, we're going to cover three crucial aspects of financial management: bookkeeping, building a budget for success, and tracking and managing cash flow. By the end of this video, you'll have the tools to streamline your bookkeeping, build a dynamic budget, and keep your cash flow healthy. Let's get started. First up, bookkeeping. A well-organized bookkeeping system is critical for tracking income and expenses, complying with tax regulations, and understanding your business's financial health. Let's go over the key steps to set up an efficient system. Step 1, choose a method for tracking transactions. You can either do this manually using spreadsheets or go for accounting software like QuickBooks or Xero. If you're a freelancer or have a small operation, you might start with Excel. But as you grow, automating your bookkeeping will save you time and reduce errors. Example: a freelance graphic designer using Excel to track client payments may later switch to QuickBooks as the client base grows, saving them hours each week. Step 2, open a separate business bank account. Mixing personal and business finances creates a mess, especially at tax time. A separate bank account keeps everything clear and makes tracking easier. Example: a coffee shop owner separates business expenses, like ingredient purchases, from personal spending to simplify accounting and avoid IRS red flags. Step 3, set up a chart of accounts. Your chart of accounts categorizes every transaction into groups like revenue, rent, payroll, and so on. This is key for financial reports. Example: a small restaurant might have a chart of accounts that includes food costs, sales, rent, and utilities to track various expenses and income. Step 4, establish a bookkeeping schedule. Whether you update your books daily, weekly, or monthly, consistency is key. Regular updates help you spot financial issues early on. Example: a retail store enters daily sales and reviews expenses at the end of each week to ensure all bills are paid and accounts balanced. Now, let's dive into the two main accounting methods: cash and accrual accounting. Cash accounting records transactions when money changes hands. It's simple and used by many small businesses and freelancers. Example: a freelance writer receives a payment today for a project completed last week and records the income on the day it was received. Accrual accounting, on the other hand, records income and expenses when they're earned or incurred, regardless of when the cash is received. This gives a clearer picture of your financial performance. Example: a web design agency bills clients for work in December but receives payment in January. With accrual accounting, they record the revenue in December, matching it with the work done. Key takeaway: choose the method that aligns best with your business model. Cash accounting is simpler, but accrual gives a better long-term view of profitability. When it comes to bookkeeping, the right tool can make a huge difference. QuickBooks Online, one of the most popular accounting software tools for small businesses. It automates invoicing, categorizes expenses, and syncs with your bank accounts. Xero, similar to QuickBooks, but often preferred for its user-friendly interface and robust invoicing features. FreshBooks, great for service-based businesses, offering invoicing, expense tracking, and time management. Example: a landscaping business uses QuickBooks to track client payments, handle payroll, and reconcile bank statements, keeping everything in one place. The tool you choose should depend on your business needs, budget, and scalability. Lesson 2, building a budget for success. Forecasting revenue and expenses. Now, let's talk about building a budget. The first step is forecasting revenue and expenses. Forecasting revenue. Start by looking at historical data, market trends, and upcoming opportunities. If you've been in business for a while, use past performance to guide future predictions. If you're new, look at industry benchmarks and market trends. Example: a retailer forecasts holiday season sales by analyzing data from the last 3 years and looking at economic trends. Forecasting expenses. Next, predict your costs. Start with fixed expenses, things like rent, salaries, and insurance, which remain constant month to month. Then look at variable expenses, like utilities, materials, and marketing, which fluctuate depending on business activity. Example, a small bakery forecasts rent and payroll costs as fixed, while ingredient costs and utilities vary based on demand. Finally, don't forget to factor in unexpected expenses. Always leave room in your budget for emergencies. Creating a flexible budget to adapt to growth. A flexible budget is one that adapts as your business grows or faces changes. It's dynamic, allowing you to adjust spending in response to real-world conditions. Step 1. Establish baseline expenses. These are the costs essential for operating your business, like rent, utilities, and payroll. These don't change much regardless of how well you're doing. Example, a small marketing agency has baseline expenses like office rent, software licenses, and a skeleton crew of employees. Step 2. Create spending tiers. Develop different versions of your budget based on performance levels. For instance, you might have a budget for average months, a lean budget for slower months, and a growth budget for when things are booming. Example, a clothing boutique has 3 spending tiers. In slow months, they reduce marketing and inventory purchases. During peak seasons, they increase their ad spend and stock more products. Step 3. Monitor and adjust. Regularly review your budget and update it based on actual performance. If sales are lower than expected, reduce variable expenses. If business is booming, you may want to invest more in growth opportunities. Tracking and managing cash flow. To ensure positive cash flow, here are some tips. 1. Review cash flow statements regularly. Look at your cash flow from operations, investments, and financing. This will help you spot trends and identify where improvements are needed. Example, a software startup reviews its cash flow statements monthly to track expenses related to product development and ensure that revenue from sales covers these costs. 2. Speed up inflows, delay outflows. Encourage faster payments from clients by offering early payment discounts. Delay your own payments where possible. Example, a freelance graphic designer offers a 5% discount for clients who pay within 10 days. They also negotiate 60-day payment terms with their suppliers to hold on to cash longer. 3. Manage accounts receivable efficiently. Send invoices promptly and follow up on overdue payments. Example, a web design agency sends invoices immediately after project completion and offers a discount for early payment, improving their cash flow. 4. Build a cash reserve. Having a cash reserve ensures you're prepared for unexpected expenses or downturns. Aim for 3 to 6 months' worth of operating expenses in your reserve. Asterisk, example, a bakery sets aside a portion of their monthly profits into a savings account, building a reserve that can cover rent,